I'm excited to welcome Alexis, Houssou, Keren, Beit-Cohen from EIT, and Tomas, Kemtys from Contrarian Ventures. So what I'm going to have us start with is just a small introduction for each of you, of talking a little bit about yourselves and your background and how you came to be doing Micromobility Capital.
So good morning. I'm Keren Beit-Cohen. I'm a business creation manager at EIT Urban Mobility. I work for our headquarters in Barcelona, responsible on our startup ecosystem. And EIT Urban Mobility is a private public company, co-founded by the European Union. And unlike the a common stigma, we are not a grant provider working for charity, but we invest in early stage mobility startups with a good ROI potential and a clear social and environmental impact. So, yeah.
Thank you.
Yeah, you're welcome.
Alexis.
Hi everyone. Thanks for having me first. It's really exciting to be here, and it's been a long time that I haven't been to a conference, and seeing the room full, makes me really happy about the micromobility space. So my name is Alexis Houssou. I run a HCVC. So 7 years ago, I started a community for hardware startups called Hardware Club out of Paris, and we expanded now to about 40 countries. That community has about 600 startups that we kind of support and help with different type of resources. And on top of that, we built a fund that's called HCVC that manages a little over 125 million now. Across, and we've invested in about 50 companies across Europe and US, from pre-seed to Series A. Check size ranges from a couple hundred K to a couple millions. So quite excited to meet some of you later today.
Fantastic, thank you.
Awesome,
Tomas.
I'll finish up. So I'm Tomas, I'm one of the partners of Contrarian Ventures, so it's two of us running the firm. We have a couple of funds. We're a climate tech focused firm, building a big firm with subsectors in the climate tech being energy tech, micromobility, mobility, transportation, logistics, built environment, and a few other topics. So we're quite open on that front. We don't do food tech, we don't do agriculture tech within that climate tech space. We write checks from $500,000 to $2 million in the seed stage and sort of 2 to 4 in the Series A stage. We also run a few things on the side, sort of Energy Tech Summit, one of the largest energy tech conference in Europe. We run a Tech Challengers competition for startups once a year. We do this, we had an event 2 months ago. Run Climate 50 programs, sort of all the climate tech funds in the world. And so do a lot of things on the side as well. So happy to connect and to be here.
Excellent. And can I just ask as well, so you've done the investment in Zumo?
Yes.
Yes. Excellent.
We've done investment in Zumo, we've done investment in Vianova, another mobility company that's also here. So happy to talk about that later, maybe.
Yep, absolutely. And Alexis, you as well?
Yeah, I'm not an investor in Zumo, but I'm an investor in a company called Cowboy. I think the founder was actually here yesterday, one of the founders.
He was. Marvelous. Cool. Cool. Well, look, I also want to give a little bit of context on the journey that we've been through. I mean, since we started doing this micromobility, I started the Micromobility podcast with Horace Deju in 2018. And at that stage, it was sort of the very early days of Bird and Lime. And subsequently, since then, we've raised billions of dollars for the space. I think you could even take that a step further back and go back to the sort of the crazy period of Mobike and Ofo raising capital in China and spreading their bikes all over the world. But we've seen this sort of boom-bust cycle of micromobility, oftentimes exploring with new business models. And what we've seen really in the last probably 2 years, especially post-COVID, it has been a real shift towards things like owned companies like Cowboy and Van Moof for raising, and then other companies as well, such as Zumo, that have really taken and explored new business models for things like subscription business models for e-bikes, etc. So, as we explore this space, I think, the thing that we've kind of seen is just sometimes that works, sometimes it doesn't. And anybody who's spent time looking at Bird or Helbers recently in the share price, it's clear it's not gone super well when we get into the public markets for some of the micromobility companies. I'd really love to just understand what are you seeing in terms of appetite for funding for new vehicles that are coming through or new ventures that are coming through? And I put that to all three of you.
Yeah, I'll start with the hard question. For us, at Beit Urban Mobility, actually now we're actively scouting for hardware company, early stage company. And we really believe in this direction. Yes, of course, there have been some, recently we hear more and more about difficulties of in this specific niche, but I think the appetite is there. I think we're all going there. Of course, it will be improved in time with, and with the evolution of this specific niche, but of course, always a place, yeah.
I can continue. So your question was about sort of, is there still funding for micromobility?
Yeah,
anything
appetite,
Yeah, appetite, yeah. So I think a few things to mention. So first, big disruption was COVID. That was, I think, net positive for everyone here in the audience. It shook up the world, but I think the world started looking at things, the way people move, the way, you don't have so many cars on the street, you have so many people walking or using bicycles. It's as a nice, freeing thing. I think this funding downturn in the environment, public stocks crashing, I think it's important to understand how this sort of VC structure works, right? If we have a new fund coming up, or you guys have still dry powder in your fund, so I think nothing in terms of the thesis have changed in the negative side in the micromobility or mobility sector. Obviously, then there are subsectors that are different, like scooters, maybe 10-minute grocery deliveries. But as long as there are funds who have LP commitments for the next 10 years or 5 years to invest in new companies, especially in the early stages, I think there's always going to be the appetite. Nothing changed within the industry. Parameters haven't changed. It's still very, very attractive. VCs can make money, and they made tons of money over the last years. I think the last couple of years were the best venture capital years that they ever had. I think people sort of say if you were not happy as a VC investor with exits over the last 2 years, you're definitely in the wrong industry. You're doing something very, very wrong. Obviously, we are a young firm. We've started 5 years ago, so for us the cycle is still gonna hopefully come later. But yeah, funding for us at least is as strong as it has ever been, especially in the early stages. The growth stages, that's a very different story. The valuations have changed. If you talk about crossover hedge funds, for them, you got private and public markets mixed up. So if they start seeing good IRR opportunities in the public space, they're probably going to lower the investment amounts in the private space. But in the early stage, we haven't seen many changes so far. So I think environment has been as robust as it ever been. And the best vintages of the funds and startups are often started in the crisis mode, like Airbnb or Google or PayPal. So
absolutely. Alexis?
I definitely agree with that. I think what we've seen over the past few years was like exuberant kind of, bull market where everything seemed easy. And I think a lot of micromobility startups were able to ride that. I think what we've seen with a lot of SPACs, especially in companies going public, is some of them weren't necessarily ready wouldn't have been ready for an IPO, and they actually used other mechanisms to become public. They're paying the price for the fact that they probably went too fast now, and that's what we're seeing with the share prices that you mentioned. When it comes to early stage, I agree. I mean, we're definitely deploying the same way. My role as a VC is not to decide when to invest; is to find the best founders, and I let the job to my LPs and to the investors that invest in our fund to decide, how they want to allocate. But my strategy is to deploy and find founders. Obviously, what we're seeing now is we're seeing a repricing. So obviously, what was probably a $100 million or $200 million company a few months ago is probably seen differently and getting repriced. Whenever you see those repricings in any market, you have this phase, this kind of pause where people need to adjust to the new reality. So founders need to adjust to the fact that they're maybe not a billion-dollar company anymore. And VCs on the other side are trying to wait until the founders realize that to do more deals. So I expect what we've seen in the past few months, we've seen probably less deals happening, but my view is that in the next few months, things are going to start kind of going back to normal again. Valuations being repriced, definitely, to maybe normal levels, right? I think what we've seen over the past few years was sometimes a little exuberant on the valuation side, at least.
Absolutely. One thing I'd actually love to ask you, Keren, is I think what's very interesting to me about the EU funding market is that there's a lot of state support compared to, for example, the US or a lot of other places around the world. And one of the things that I think has been really interesting is that EIT was founded, it's not doing grants, it's only doing equity investments. How do you think about it? You obviously came to this from having been in Israel. Is this new? How do you think about it as a kind of state-backed model, and what do you think that kind of enables for European startups?
So if I understand your question correctly, you're asking about the way through which the
I mean, I guess it's just how does it assist bringing something to market? Is there a sort of a specific advantage in the EU around that?
Yeah, absolutely, especially in terms when it comes to micromobility startups, because micromobility startups, I think more than any other startup, are really dependent on the ecosystem. So in EIT Urban Mobility, we support early-stage mobility startups in three ways: acceleration programs, investments, and growth support. So acceleration program, we've got 6 thematic accelerators this year, 3 out of which have a direct link to micromobility. So the E+ accelerators run by our Spanish and Southern European partners. The city logistics run by German, Israeli, and Turkish partners. And we've got the public realm in East. Yeah, I think 60 startups will be accelerated with us this year, adding to the 130 already graduating. And we are 2 years old, so it's it's a nice direction. Investment-wise, we've invested so far in 40 mobility companies. At least half are within micromobility, mostly in software and data, smart cities area. So we see here Fluctuo, Vianova, Luna, Kogo. So I'm happy to see all of them here around. Our tickets run between 50 to 500 Ks. And we're known to be an investor with a hands-on approach, so we are active as a shareholder, and that leads me to the third point, which is growth support. So EIT comes with a huge pan-European network. And in this network, we've got cities, the biggest cities in Europe, industry partners, research institutions, and universities. And when a startup becomes a portfolio company in EIT Urban Mobility, he gets direct access to this network, which enables him to pilot with the biggest cities, to get contacts with his real environment, real testing beds, and so.
Yeah, I think that's also
it's amazing. I mean, Israel, we don't have it in the US, same. So this is amazing.
Totally. I mean, I think it's also interesting as well, just from the nature of having seen a lot of the early micromobility companies really not understand that oftentimes they're operating in highly regulated environments, and so having that support there, I think, is certainly interesting. I want to change tack a little bit as well, because we've got sort of semi-public and then 2 private funders. I am very curious. I know, Tomas, you invested in Zumo, and one of the things that I've seen about Zumo and also about Revel as well has just been that they've been incredibly good at raising debt equity, and that was, I think, one of the things that Mina at Zumo has been incredibly effective at. How much did that factor into your decision to invest in them? Because I think what we've seen really has been that equity, as you say, lots of people raised lots of equity money, they spent it all on scooters that got burned or thrown in canals,
Yeah, great question. When we invested in them in 2019, I have to say we didn't think about it that much. I think the business model wasn't that clear. It was super early. The guys were leaving their jobs, were about to. They were thinking whether they wanted to do a business, and we were brainstorming for 6 months. They decided to do a business. We co-invested with Maniv, and the company sort of started. Obviously, a couple of years later, with 10 or 1,000 plus bikes out there, equity money dried up very, very quickly when you have to buy expensive bikes, off-the-shelf bikes, and place them for the subscription. We started thinking about it. So I work with the CEO a lot in this venture debt thing. I think I've sort of said, hey, let me handle this, let me help you on this. Let us sort of do the financial models together, and let me talked to all the venture debt providers. I think we came up with a list of maybe 40 venture debt folks, project finance folks around the world, and sort of we did interviews with them, seeing what could fit for early stage companies. And I think in general, Europe is a great place for this, for the green thing, all things green in general. You know, we have especially, you know, guys like Rabobank is a big green bank, can really do great things at very low rates, because, you know, venture debt still can be very, very expensive for early stage startups. Like the problems we had in the e-bike space, a lot of the venture debt providers didn't know how to price second-hand used bike. So they couldn't put much value on it. They couldn't say, look, 3 years later it's going to cost you 80, 60, 100% of the value. So now they got more data, so they can lower down the interest rates. But the interest rates were in like high 10s, or like almost close to 20%.
Wow.
The offers we were getting from the venture debt providers. It's a new industry. It's a hardware. You know, they love the software, recurring businesses. They can, with the cash flow, known cash flow for the next 3 years. So, but Europe is getting much, much better, especially the sort of national banks with big, big programs. So I think but the thing is, you have to do an assembly, have to have people in Europe. You know, if you want to still do your things in China and Taiwan, which most of the world is doing, it's going to get a little bit trickier, because it's still all the incentives are take the production back to Europe. So, but I think it's getting better. I think obviously as the company matures, there's a lot of data points, interest rates. You know, venture debt is out there. It's just how expensive it gets, right? And you have to be very, very careful what kind of debt you can support, you can service as a company. But obviously you always have to raise equity, because you can't get venture debt just without any equity. So we've been very, very careful about it, and the later you go, the more important it gets. And it's just how fast you can scale, right? Without venture debt, these type of businesses just can't scale.
For sure, and I think that's the space, I think, has really evolved a lot in that space. And as you say, I think in the early days we just didn't have the data, and whereas we're there now. Alexis, the saying, famously, hardware is hard, you know? And we're seeing this especially now. I mean, I've got a number of my own venture investments that are in hardware, and supply chains have been decimated in the last year or two. How does that change how you think about it, and how do you advise your companies around that part of the equation, especially when it comes to raising or thinking about raising capital?
Yeah, no, I think, you know, first, hardware is definitely hard. I mean, I can say that, but I think there's a lot of value if you do it right. I think that's the key thing. Yeah, supply chain has been tough. You know, I'm not gonna lie. I mean, last year it was like we had a few of our companies that, you know, couldn't really get products, and, you know, it was hard. And, you know, I think on your question on what we told our companies to do is like get closer to your suppliers, really build those relationships. I think, you know, we were talking about Taiwan and Asia in general earlier. You know, there's a lot of human connections as well that you can build with suppliers, with the C-level, or with the CEO of the company that's doing the brakes, for example, for your bike. Or, you know, I'll give you an example. One of the founders at Cowboy went to Taiwan a few months ago, and he was actually still under lockdown, so he had to wait. He had to be kind of almost in prison for 2 weeks in his hotel room, like just to have a few meetings with suppliers that were really key to the business, right? So that's kind of a very big commitment, not to be able to leave your hotel room just to be able to meet some of your suppliers. So that's the kind of thing. I think, you know, what happens in those circumstances is companies that are better financed and better funded are able to put more money on the table to secure allocations for the future. We've seen companies do that, and I think that's not improved things on the working capital side, but that's definitely been you know, a weapon that some of the companies could use. As of what do we think of the business, and, you know, it doesn't really change our view on the space. Like, we'll still invest in a great business, and we believe a business is, you know, inherently good, whether the supply chain is hard or not. We'll definitely think about how the funding cycles. We'll definitely think about how to phase different, you know, parts of the growth kind of curve, you know, taking supply chain into account. But, you know, I expect things are going to go back to normal, or to maybe a new normal. That's probably gonna cost more, and, you know, transportation and assembly than it did in the world that we knew. But, you know, things are coming back, and you know, I'm not necessarily extraordinarily worried about the space. Yeah.
Yeah, you've got a very good point. Hardware's hard, but there's a lot of value there if you get it right. I love that. Tomas, Alexis, we've seen the Bird IPO happen, we've seen Halbers happen into public markets. And like I would say that you could say overwhelmingly the markets have rejected these. And I know that a lot of people, especially I've been having conversations the last couple of days, and people are like, oh look, this reflects really badly on micromobility. Do you think this is reflective of the entire space? Do you think that that's going to change any of the conversations that you're going to be having now, or is it's irrelevant for you, for the businesses that you're looking at?
Yeah, I don't think it has anything to do with this subsector and industry. I think SPAC is in general was I don't know how to put it nicely, not to offend anyone, but we had 2 companies from our portfolio being approached by SPACs, and the boards very quickly voted that down as seeing way more reputational risks than actual any benefits, and we're very happy it didn't happen. These companies were way too early. One of them was pre-revenue but doing great things, and a SPAC sponsor comes out and says, look, I can get you 800 million valuation in a month's time. You won't need to do any work. I got 5 bankers lined up, and it just didn't feel real. It didn't feel, I think, and the founders also felt like, the founders looked at them, it's like, hey, this is a quick way for me to really cash out. I thought I'm going to be doing this for 10 years. Now I've been doing this for 3 years, and I have an opportunity to cash out 100 million plus, So obviously, if you're a young person, haven't had exits before, of course you're going to think about it. But, we're very happy we didn't go that way. We've seen companies being absolutely obliterated, 80, 90%, and it's real hard to come back out of that. You under absolutely different public scrutiny when you're a public company. Everyone knows that. I think happily the regulation is changing. I think what SEC is doing over the next couple of months, I think that it will be as hard to SPAC as it is hard to IPO, which is very, very hard. You have to be ready. You have to be institutional company with all the checks and balances in the company that you can run it as a public vehicle. What we had before, I think, was a little bit nonsensical. However, it was great path for some of the companies, but most of them were too early. I think Helbis is trading at 34 million market cap as of yesterday. I mean, I think they're trading below the cash balance, which means public investors think that it's a default company. So, is it good for them? No, I think it was a mistake to do it. Maybe a bit of a greed, but it is what it is. I don't look at it as a negative to the micromobility. I think it was just a few things.
Not reflective of the entire space.
For us, definitely not.
I think, one thing to say about the markets, because I started my career actually, working on the markets, is the markets are, very accurate on the long term and they're very wrong on the short term. It's like your, I don't know, your overly dramatic friend that's like, when they hear bad news, they're going to think it's the end of the world. And when they hear good news, they're going to say, well, sky is the limit. But, things correct, right? And that's what we're seeing. They usually correct too much. But it's happening everywhere, right? So it's not just micromobility. I don't think that necessarily there would be any specific impact. The one thing is, I think, a lot of micromobility startups and the Birds and all of that, rode that wave, like really used and were at the right time to kind of catch those opportunities with SPACs, etc. So I think that's more like, the explanation of why there's so many of them is probably because of, the timing was a match. But yeah, it was too good to be true. Like, those businesses weren't ready to be public companies. And now, like, the market's telling them, well, it was too good to be true, right? Yeah. So, and it's saying that, it's actually not saying that, it's shouting that. And so that's what I would say. I don't think, companies building great things, especially early stage, should be focused on the long term. What has happened over the past few years, and last year I was like, we're at the peak of the bull market. At some point I was like wondering why I was in this business. Everyone was thinking short term, was thinking about how am I going to get my company funded, how is another investor going to reprice me in the next 4, 5, 6 months. I've had crazy conversations with entrepreneurs or with co-investors on companies that were only looking at how am I kind of marking this up in the next 6 months. Yeah. While we're in the business of building businesses, it takes time. We should be focused on that. There was a lot of tourists that were coming into the space because there was quick money to be made. And I think, Tomas was talking about that, about the fact that people had some FOMO about not being in the market. So I think what this crisis is doing is also cleaning this up and probably leaving the right, people that are in the business of, inventing new technologies, building new stuff. And I think that's going to be positive long term.
Yeah. Well, look, I want to finish up with a question which is one of the things that I've noticed, so I'm the podcast host for Micromobility. I'm also an angel investor myself, and I've been spending time, obviously, talking to a lot of venture capitalists who are in this space, and yet it feels in some ways like what we've had is a really, a lot of the micromobility businesses that have been built on venture capital. And yet where I kind of see the market going, and maybe we're starting to get there with things like venture debt, is like new and alternative, kind of more established capital markets actually starting to look at this space and saying, hey, we want to have a part of this, we want to be excited about this as well. And I'm just kind of curious, is this where you think that, like, is this where we're going to go? Is there a role, where is the role for venture capital in this? And then where is the role for PE? And where is the role for government programs and government support, et cetera, et cetera? And we'll start with Keren, Alexis, and then Tomas.
Well, I tend to agree with your thesis for two reasons. One, I think that micromobility companies, especially, again, talking about the hardware companies, they're sort of a hybrid between a normal startup and a normal company. So there's something that hardware companies might not adjust or might not answer to the, let's call it, acceleration patterns as like normal hyperactive startups, which in turn can lead to maybe different expectations from VCs and the inaccurate guidance of the founders. So that's one reason. Second reason is, again, the dependence of micromobility startups in the market, in cities, in municipalities. So they cannot just find product market fit out of their home offices, in front of the screen. They really need to be there, out there, engaged. And if you're an early stage startup, this is extremely difficult to get this opportunity. And this is where an investor such as EIT Urban Mobility enters the picture. So, there's no replacement to VCs in terms of level of professionalism and, of course, ticket sizes. But something I think might be a better fit for early stage mobility startups using the combination, as I strongly believe in the coexistence of contradictions of institutional investor, European investor, and an angel investor or an early stage VC, more open-minded and less focused on aggressive acceleration plans and ROIs. So that's my opinion.
Thank you.
Yeah.
Cheers. Alexis?
Yeah, no, I was thinking about your question, but I don't know if we'll see more. When I look at rounds today, they look the same in terms of structuring that they looked a few years back, which is like it's mostly dominantly VC, right? But I also look at opportunities. I'm biased because I evolve in this space. I think there's definitely, especially in Europe, some help that can come from like public funding, etc. I tend to be careful with that because I also know that I've seen companies evolve, stay alive for a long time, especially in France back in the days. There were a lot of companies that were kept alive by public funding, and I think also through COVID, what we've seen with a few companies is the government help sometimes also kept some companies running that should have been that, and I think we have to be.
We could say that about car companies as well, though, right?
we should. Most car companies should be that, right? By now, I think in France we have a few players that are just publicly. They have a social footprint that's too big for the government, like Renault and a few others. Where even if you look at we're talking about asset prices versus what the market thinks. Literally, the market doesn't think there's any business there. My thinking around this is just, I do think great businesses are going to get funded by VCs. I do think that there are businesses that are worth existing that are not necessarily VC fundable, and I think those, should look at other opportunities. I think one just quick thing I would say about this current environment is especially when there's a crisis, especially when there's a repricing, everyone's more focused on unit economics, everyone's more focused on can you be profitable, and if you can create, or if you can, go in a different way and be profitable early on, there's a lot more options for you in terms of funding.
Yeah.
And banks are actually, very happy to lend you. But again, that's a slightly different path.
Yeah.
We're telling a lot of our companies that have, or that they have the opportunity to potentially, become profitable in the next 12 months to kind of consider those options now. because definitely, from a funding perspective, that opens way more options. Yeah.
Yeah, fantastic. Tomas?
Yeah, I guess I can finish up maybe talking about more hardware type startups.
Sure,
I think
sure.
venture debt is going to get is in the very early innings still. I think it's going to be very, very interesting, and I encourage people to look at it a bit more. And there's more and more funds and money coming up, and LPs, so investors in the funds, are more and more interested in venture debt. I think, and if you in hardware, think about project finance, think about infrastructure funds. That it's really when you start talking unit economics, when you start talking profitability and sort of ROI, these type of metrics, which you don't really talk about when you invest in pre-seed or seed stage startups. I think that's still going to be dominated by angel, VC money, and programs like EIT. But in the later stage, I think that's venture that's going to, I think, play a very big role in the near future.
Fantastic.